Okay. Okay. Okay, Gopiya Miss.
Yes, go ahead.
Okay. Good afternoon to one and all. Myself, Dr. Minimol K. Saver, Assistant Professor on Contract, Postgraduate Department of Commerce, Sree Sankara College, Kalady. Respected resource person, faculty members, and dear participants. This is the 6th day of Faculty Development Program on Personal Finance and Investment organized by the PG Department of Commerce, Sree Sankara. Welcome today's resource person, Honorable Dr. P. Balasubramanian. Dr. P. Balasubramanian holds triple master's degree in business administration, commerce and management, and possesses more than 15 years of experience to his academic career with a specialization in finance and economics. He completed the Doctor of Philosophy from Bharatiyar University in Behavioral Finance. He has a blend of teaching current trends in management, both theory and practices, and also by sharing his rich academic experience with practically women students and executives in various concepts. He presented 30 publications in national and international conference sponsored by AICTE, UGC, IQAC, and 12 papers in national and international scopes index journals and one A category journal. He has guided 16 MPhil research scholars and guiding 6 PhD scholars. Out of 2 scholars got awarded. He is an examiner for PhD thesis evaluation of University of Kerala, Mahatma Gandhi University, Bharatiyar University, and Karpagam Institute of Higher Education. He also serves as visiting faculty to many business schools, colleges, and few universities in the Department of Management and teaches financial and economic aspects of management education. He holds many professional membership in Kerala Management Association and panel member for many academic institutions and business organizations. He is actively engaged in research consultancy with the Kerala Institute of Labour and Employment. He holds the Best Academic Dream Award for his outstanding teaching in MBA stream and Senior Educator and Research Award in 2014 by National Foundation for Entrepreneurship and Development, Coimbatore. He has served with the Sree Saraswati Tyagaraja College, Pollachi, and Sri Ramakrishna Institute of Technology, Coimbatore, as an assistant professor, senior grade at Department of Management, and he has worked as a dean of academics and executive member of honorary post at NFED, Coimbatore. He has the chairman board of studies in commerce and member of faculty committee Amrita Vishwa Vidyapeetham. Formerly, he has headed the department for three and a half years. Presently, he is working as an assistant professor, senior grade, and chairperson of Department of Commerce and Management, Amrita Vishwa Vidyapeetham, School of Arts and Science, Kochi campus, Kerala. I welcome Dr. P. Balasubramanian for today's session. Welcome, sir.
Thank you, madam. Thanks for your nice introduction.
Thank you.
Shall we start, ma'am?
Yes, sir. Sir, could you please switch on your camera?
Yes, ma'am. Okay, am I visible?
Yes, sir. We just want to take a screenshot, sir.
Okay. So I will share my PPT also.
Okay, sir.
Is it visible, ma'am?
Yes, sir. Yes.
Okay.
Yes, sir.
So very good afternoon, respected management principal and faculty development program coordinators, members of the faculty and audience. Very good afternoon to one and all present here. So it's highly delighted and pleasure for being a resource person on the topic of currency derivatives, a choice of investment on the 6 days faculty development program of personal financial planning. So the topic given to me is currency derivative, a choice of investment. As far as in the present scenario, we want to think about most investors want to make investment in such a way that they get sky as a high returns as quickly as possible without the risk of losing any principal money. So this is the reason why many are always on the lookout for the top investment plan where they can double their money in few months or the years with a little or no risk. However, a high return, low risk combination in an investment product unfortunately does not exist. So maybe in an ideal world, but not at present, if you see in reality, risk and return are directly related. They go hand in hand. That is, higher the return, higher the risk, and vice versa. So with this contest, I'm introducing the concept why we want to discuss about the currency derivatives. Because we have the various choice of investment. Out of that, why we want to take about the risk and return concept. If you see any investment scenario, as far as the investors are concerned, we have to adopt the 6 features compulsorily. Safety of principal, liquidity, stable income, capital growth, legality, and tax implications. So based on the fundamental features only, we as investor, we can go for further investment in any of the choice of investment avenues. So depends on that, the risk and return may vary. But as far as the investors are concerned, there are a golden rules of investment. I hope the slides are moving, right?
Yes, sir.
Okay. So as far as the golden rules of investments are concerned, the investor mentality is we want to invest early, invest regularly, invest for long-term things. We won't plan for the short terms. But as far as if you see the currency derivatives, for example, if I can note, if you see in the global market contest, we have to understand why people come for the derivatives. So what do you mean by the derivatives here? So these all we will be discussing. Next, if you see the investment alternatives in India, we have a plenty of options. We have the plenty of options. So out of this, you might have learned more concept related to for the past 6 days or 5 days. So you have two persons, resource persons, they might have taught you in various dimensions related to the financial planning and as well as the investment strategies, etc. So as far as the investors are concerned, we have equity markets, bank fixed deposit, bonds and debenture, currency market, post office savings, mutual funds, commodity markets. Now, based on the various investment, why we are focusing on the currency derivatives. So if you see that investment has grown more complicated in recent decades. So with the creation of numerous derivative instruments offering a new way to manage money, right? New ways to manage the money. What do you mean by currency derivative? These currency derivatives are the financial contract between the buyer and seller involving the exchange of two currencies at a future date and at a stipulated rate. We called that is currency derivatives. So this currency derivative trading is suitable for those interested in reducing their foreign exchange rate risk. This currency derivatives in India provide a bundle of opportunities for a number of players, so-called the investors. So take this opportunity to effectively manage your international exchange rate risk with currency trading in India. So this rate keeps on changing constantly. So it means the rate talk about the value of one currency in terms of another currencies. So that is not fixed at all. So the price of currency, it may change, either it shows the strength or that's so-called the appreciation or the depreciation, the weakness over the other countries' currencies. So these rates keep on fluctuating constantly. So it does its effect on many institutions, individuals, investors, etc. Those who are investing in this currency market. Normally, if I say the use of derivatives to hedge the risk and improve returns has been around for the generations, particularly if you see the farming industry, where one party to a contract agrees to sell the goods, or the line stock to the counterparty who agrees to buy those goods or on a specific date. So this contractual approach was the revolutionary when first introduced, replacing the simple handshake. But the simplest derivative instrument, the investment allows the individual to buy and sell an option on a security. So the investor does not own the underlying assets, but irrespective, he or she makes a bet on the direction of price movement via an agreement with the counterparty or the exchange. So there are many types of derivative instruments that include option, swap, futures, and forward contracts. So this derivative, if you see, as far as the cash market is concerned and the future market is concerned, how it mitigates the risk by looking into the currencies. So you have a combination of US dollar, Indian rupee, Euro currency, Indian rupee, Indian rupee, Japanese currencies. So like that you have the combination. So gain or loss in cash market plus loss or gain in future market, which will mitigate your risk. Right. I hope you could able to follow me. So the preferred investment choice is equity market, rather than, if you see the investor mentality, investment in fixed deposit, post office savings, recurring deposit, postal life insurance, etc. on the various domain, most people preferred, or the common people preferred, followed by the commodity market and the currency market. Next to the equities. So the least preferred option for investment is bank fixed deposit, because this fixed equity market is still the preferred choice for investing the money deposit, despite it have the high risk and fluctuations. But whereas if you see the mutual fund and the post office savings are still considered to be the better than bank fixed deposit, because the interest rate has been reduced to 5.1 or 5.3. Right. Now, if you see the growth of global currency derivative market, I'm talking about the global scenario. The figure indicates 1,35,453 billion of every 2008, which diminished to rupees 97,913 billion for every 2009. So from the year, if you see the 2010 onwards, from the year 2010, if you see the market of currency derivative bounced back to its performance with rupees of 1,09,021 billion and proceed with the hike performance from 2011 till 2017. I have given you the figure. So this shows the amount of a progressive trend towards people investing in currency derivative market. But whereas if you see the growth of Indian currency derivative market, it uncovers the growth of currency derivative in India. So from the marginal performance of 1,27,000 something billion out in 2008, the hike proceeded till 2017. Example, I'll tell you. In 16,937 billion of every year 2009 and 22,200 billion out of 2012, if you see that figure, in the year 2017, the hike kept on being substantially a huge figure. So that leads to 42,226 billion. So it's all shows the progressive trend. Right. I hope now I am making you to understand the concept. So this currency derivative has offered two things. One is currency option, the other is currency future. If I say the currency option, it talk about the buyers has the right to trade a specific currency at a preset exchange. We call that is currency option. Whereas the currency future, the traders has a contract to trade a specific currency pair quality at a preset rate and date. So we say that it is an agreement to swap the exchange payment flow into two different currency with each other on different dates. We called it is a swap. Whereas if you see the currency option, then I'll come to the currency futures. But here, most of the PPTs I have concentrated more on the currency futures. The option talk about, it's a financial contract in which the buyers have the right but not the obligation to buy or sell the underlying at a predetermined price on the predetermined future date. So there are two types of option. One we called a call option and another is put option under currency option. So the call option provide the holders the right but not the obligation to purchase a certain currency pair at a specified price. That's we call it as a strike price for a certain period of time. Whereas if you see the put option, it gave the holder the right to sell a certain currency pair at a specified strike price. That's called in specified price. So the seller, the so-called the writer of the put option, is obligated to buy the stock at a strike price. So that the currency option trading is also a very effective tool as it provides better strategic investment opportunities. So the online currency trading provide an opportunity to trade in currency options and the strategic your currency trading in India more effectively. So this is how the system work. Whereas if you see the currency future in India, it involves the financial contract in which the parties have the obligation to exchange their underlying currencies at a predetermined price on the expiration's date. So this currency future are a linear product, and the procedure of calculating the profit or losses is similar to that of the index future. So this currency trading, it can be traded, the currency future can be traded in NSE National Stock Exchange, BSE, and multi-commodity stock exchange. So if you see almost various the banks, the HDFC Bank carried out the first trade, right? So that have constituting the 15,000 contracts. So the bank contributed 40% of the total gross volume. So these all a good initiative that has been incorporated from 2008 onwards. Right? If now you can see the specimen copy of the contract specification in currency derivatives. So now you can see the underlying the currencies combination: US dollar, Indian rupee, Euro, Indian rupee, and Japanese yen, Indian rupees. Right. So what is the purpose of trading that we want to discuss? If you see the major purpose of trading, one for a good earnings. So any investor purpose will be very specific because everyone will feel that they want to make a good earnings, because none of them will say that my purpose is different. Second, investment. Second is investment. Third, financial support. Third, financial support. Fourth, people may take it as a profession. People may take it as a profession. Next, people may consider it as others. Why I'm telling is such as far as any investments is concerned, how people are considering that option. There has never been a better time than right now to make a great money through Forex trading. But if you see, there might be a question, can I make a lot of money online with Forex? Absolutely. So more and more private investors are getting involved in Forex every day. So the constant promise of riches and the fortunes have attracted hundreds of thousands of new participants from all over the world. So the foreign currency rates can be tracked in real time. So the world currency rates are always trending up and down. So the key is always to buy low and sell high. So the contract size, the minimum price, you have to see that the trading hours from Monday to Friday from 9 a.m. to 5 p.m. The exchange probably from NSE and multi-commodity stock exchange. The symbols you can see here, how they're representing the Indian rupee as well as US dollar or Euro currencies or Japanese yen currencies. The tenor of the contract, how your settlement, whether daily settlement or the final settlement, T+1 or T+2. So these are all just for your understanding. Now you can see the currencies pair, how it trading terms. So British pound plus US dollar, we call that as a cable, GBP USD. Europe US dollar, US dollar Japanese yen, US dollar Swiss francs, we called Swissy. US dollar and Canadian dollar, Australian dollar and US dollar, Euro and British pound, Euro and Japanese yen, Euro and Swiss francs, British pound and Swiss francs, Swiss francs and Japanese yen, we call that a Swiss yen, British pound and Japanese yen, we call sterling yen. So this is a combination. So an expert trader can identify the current direction of the foreign currencies. So they can always recognize the way that the wind is blowing, and this translates into riches. So if you see, unfortunately, learning these market trends can be the years, can take years. So you have a software program like Easy Forex that make it easy for any investors to get into the market without any experience. So there are many other factors that determine how much money you make in the Forex market. So you need leverage, that most important factor in determining the rate at which you are making money. So higher risk also mean higher reward. So the participants with larger portfolio investments, more money into the market, and thus increase the odd of making money quickly. So as a technology, here you have the advanced and more software programs have been published to help the investors to make them fortunate. Right, I hope you could able to follow me. So these are the general combination of currencies traded in NSE and as well as multi-commodity stock exchange. Now, just for your understanding, I have given you the exchange rates. What is the initial price and the opening price and lowest price, the highest price and the changing position. We call it the fluctuations. Sometimes it have a minus, sometimes it's appreciated, sometimes it may be depreciated. I hope you are following me.
Yes, sir.
Okay. So literally say that the currency trading in India is fairly recent phenomena. So whether you are a pure hedger or an arbitrager or a speculator or a trader, you can benefit from the currency future trading by taking a view on exchange rate movements without any underlying or an economic exposure. So this is opportunity for the investor to trade in currency futures and to protect yourself against foreign exchange risk. So that's, you have a very good features of currency futures. One is this is traded purely online and prices are displayed on the real-time basis. So this 4 currency pairs which I have shown in the earlier picture are traded on the NSE, USE and MCX, right? In the combination of US dollar Indian rupee, Euro Indian rupee, Japanese and Indian rupee and pound sterling Indian rupees. Third feature, this method quotes the number of units of foreign currencies in the currency pair. So the trading symbol on the NSEs are, these are all the symbol. JPY, INR, we called Japanese yen and Indian rupee. GBP, Indian rupee, we called pound sterling, Indian rupees. EUR Indian rupee, we call it euro, etc. Just this is for your understanding. The future speculations, for example, of the new Mexican pesos, the 5 lakhs, how the maturity for that particular product in March, June, and September. So the open value, high value, low value, in what way they are settling the currencies, futures, changes to what happened. So if you see the short positions, they believe that the value of the Pepso will fall. Sometimes the long position, if you see, that can believe that the value of Pepso will rise. So how they are calculating the value of maturity for the short period and for the same value of maturity for a long period. Because short period, we say that it may fall, right? So you may not get a good returns, but whereas if you see for the long, you may get some good returns. So here I have assumed some of the spot rates for the maturity. Right. So next common thing is as far as the investment and investors are concerned, how this currency derivative have segment. So this currency market internationally is very mature and large in terms of market share. So which is bigger than the equity and the commodity market. So the international currency market are made up of banks, commercial companies, central banks, investment management firms, hedge funds, retail forex brokers and investors. So these Indian currency markets have noticed heightened activities and extreme volatilities in the last couple of years. So the development taking place in Indian forex market have brightened the prospects for the investors and traders. So based on that, the currency derivatives, you have forex futures versus forwards. If you see the contract size for the foreign currency futures, it's standardized. But as far as the forward is concerned, any size desired depends on the market. So the maturity fixed maturities. So any maturity up to a year. Allocations, organized exchange, because you have NSE and multi-commodity exchange, etc. But here, sometime it between the individuals and the banks. So the liquidity, if you see very liquid, sometimes here it is liquid, it depends on the relatively of the market situations. Right. The fees also same thing, single commissions for purchase and sell. Here the bids, ask and spreads. Right. So before entering into the margin requirement, so let I have one question, how derivatives can fit into a portfolio? How a derivative can fit into a portfolio? If I see, investors typically use derivatives for 3 reasons. One is to hedge a position, to increase the leverage, third, to speculate on an asset movements. But if you see, the hedging a position is usually done to protect against or to ensure the risk of an assets. Example, the owner of a stock buys a put option if he or she wants to protect the portfolio against a deadline. So this shareholders make money if the stock rise, but also gains or loss less money if the stock falls, because the put option payoff, that is the strategy is put option payoff. So investors also use derivatives to bet on the future price of the assets through speculation. So large speculative plans that play an to be executed cheaply because options offer investors the ability to leverage their positions. at a fractions of the cost of an underlying asset. So that's how the system works, right? So any doubt, anybody? So if you see the initial margin requirement, it held as a collateral by the brokers. Usually 2 to 4% of the contract value they may charge. So margin amount same for short position as well as the long position. The buyers hold a long positions. That is, as far as the seller is concerned, they are short. So if the settlement price is higher than the yesterday, the buyer has a positive settlement for the day. So in a long position now, we worth more. That's why the exact opposite for seller we called a zero sum game, right? So this is just for your understanding. Open interest and the total open interest. We refer to the number of contract outstanding for a particular delivery month. So initially the open interest is zero. That increase the overall the time until the positions are liquidated, or that can be predictably very low in long-term returns on the main assets. That can be include both financial and non-financial, that many investors are turning their attention to currencies as additional source of profitability and or an opportunity to diversify their investments, right? So based on this, we have to understand what do you mean by reversing traders. So it's a rare in forward market, that is 90% of all contract lead to the delivery. So common in future markets, only 1% of the contract leads to the delivery. Right. Next, Forex option. So this we called gives a right but not obligations to buy or sell amount of currencies at fixed price for a given time period. Because the call we say the buyer has the rights to purchase, the put we say the buyer have right to sell. So buyer we call the holder, and the seller we call them as a writer. Buyer we call the holder, and the seller we call them as a writer. So two options. One we call the American may exercise during the life of option. European may not exercise until the maturity. Right. So the price element is we stick it stable the exercise price for any currencies that can be purchased or sold. So the premium, you have the purchase of options, spot rate, same thing. So these are all available for the Forex options. So these may be classified at that money that exercise price is equal to spot rate. So ITM we called in that money the options profitable excluding the premium if exercised immediately. So another is OTM we called out of the money, the option is not profitable but excluding the premium it can be exercised immediately. So the market for a derivative is OTC market. So that we called organized exchange, that the Chicago Mercantile and the Philadelphia stock exchanges, they hold this particular organized exchanges. So for option for clearinghouse corporations also. So while if you see investing in currencies, then now we want to understand the behavior of currency is very difficult to predict in short term, because their performance depends on numerous variables. Just for your understanding, I'm mentioning here Forex option market, how the options underlying the strike price of three particular different months. I have put it, one for call last and for put last. So the each options here, you can take the Swiss francs option. Swiss francs we use shortly called it as the combination of that currency 62,500. So this is just for your understanding. So any field will have the speculation. So for example, I have assumed that the spot rate is $0.5851. Right. If you take 6 months forward, It's $0.5760. So if you spot market, if you see the dollar 1 lakh, expect 6 months spot, that is $0.6000. So you have to purchase the SF for so and so amount at the spot rate of so and so. So you have to sell at target spot rate of so and so. As far as the forward market is concerned, you have to buy forward in so and so market at the rate of $0.576. So if you take in 6 months, it will fulfill the forward and you can sell the proceeds in spot market. Whereas if you take the option market, long call, short call, long put and short put will be applicable. For example, if you see, suppose you have a $10 million, so you wish to speculate on euro. So how you are converting that? So you can expect this much as euro depreciates. So what is the arbitrage strategy? So you can expect this much when euro appreciates. So what is arbitrage strategy? These all we have to think about. So that's where I'm telling about example. If you see the price of the treasury bond only depends on the IRR. So when I say the IRR on investment, the return generated by the bond, by explaining it's very simple, or at the rate offered by a particular issues. So if you see that the contrast, the currencies are influenced by the multiple economic and political factors. So as well as if you see the relative factor between two countries or region. So it is not just a question of predicting how a country will perform, so in absolute terms, but the determining how it performs relative to another regions. So the long-term dynamic of some currencies are most stable or predictable than other, because the structural economic characteristics of certain region impact the depreciation or the appreciation of their currencies in a longer terms. So example, if I say the Swiss francs, which I have connoted, is the strongest currency in the world. So the another thing to bear in mind when investing in currency is that there are several alternatives to choose from. One of them is to buy asset from the country or the region is a question. So in that case of the Swiss francs example, this would mean buying bond or shares in Swiss companies. But there are two key problems with this first alternative. That means limiting your investment to a specific country. So you greatly reduce your investment universe and it country's currency appreciate significantly, so that you can the companies become considerably less competitive than those of other regions. So besides that, if you see, their income from abroad also falls those of the other regions. So significantly due to the appreciation of their currencies, the important factor that can end up penalizing their valuations or even the solvency compared to the companies from other countries. So however, there is another alternative for trying to capitalize on the appreciation of a specific currency that does not involve any channelizing the investment in countries or region. So you can invest anywhere in the world and in any asset, but with exposure to your chosen currency at any given time. So if you see, going back to the case of the Swiss francs, if I say, if you wanted to invest, for example, in stock or bond of UK companies, you could choose to invest in francs rather than pound sterling. So at the same time, and investing in the UK, you would buy a forward currency contract to exchange the currency risk. So that your investment would therefore depends as much as on the performance of the stock or bond of the UK companies as the performance of the Swiss francs. So this is how the situations can be briefed. So this is just for your understanding how profit if the spot has been decided as far as the premium concerns. So that's how I want to represent it here. So based on this, if you see, I have another short things to represent. Just I want to make you to understand. So with all in the pandemic situations, if you see the realization of a global interdependency has dawned on everyone. So the currency markets are a global market for the exchange of different currencies. So when I say that the currency market, that includes your forex markets, right? So the currency markets in India are relatively underdeveloped because it is the most liquid market in the world. So this currency market trades around the clock for every day during a week. So with the increase in international trade and globalization, the exchange of foreign currency has multiplied significantly. So lately there has been an increasing in volatility in the currency market due to the geopolitical tensions, interest rate, commodity price, etc. So the traders, investors, firms face the financial risk from such volatility. So you need hedging. The risk is need of the hour. So the currency derivative act as a meaningful tool to mitigate the risk arising from the currency derivatives contract. Right, I hope I am making you to understand the clear concept. So there might be a multiple scenario that can rise while settling the currency forward contract. That may include the actual delivery of currency on the expiry date. So the settlement of the net gain or loss on the date of delivery. An opposite spot position is executed before the expiry of the contract. So if you see on the settlement date, the net position, that is after considering the spot and the future contract, is adjusted. So that's how these things are working. As far as if you see the currency future contract, example, a lot size of US dollar future on the NSE is $1,000. So which implies that traders can be executed only in the multiples of $1,000. So a buyer cannot purchase a contract for $950 or $1,200. Right? So the future contract are executed through an exchange with virtually zero counterparty risk. So the exchange guarantees that the performance of the contract only. So the exchange requires the buyer and seller to maintain margin as specified with the exchange. So additionally, the future contracts are marked to market. That is, if you see, the gain on loss at the end of each trading day is communicated to the buyer and lessor. So closing rate at the end of the trading is considered for the calculations. So that is how the exchange of maintaining an additional margin, which is known as called the maintenance margin. So when I say that mitigate the risk associated with foreign exchange transactions, if you take one good example, as if any Indian exporter has entered into a sale transaction, the pulse of $20,000, so which the payment will be given after 2 months. If the exporter expect that US dollar price to fall within 2 months, he can enter into a future contract to sell the dollar. So at final result, the rate at which the exporter will receive the US dollar is fixed. But the transaction is referred to as the short hedge. Whereas if you see the alternatively, the importer has to make a payment of $5,000 after 2 months. So the importer will lose out of revenue if the US dollar price increases within 2 months. So therefore, he enter into a future contract to buy US dollar at a fixed rate after 2 months. So in this case, the importer is said to have taken a long hedge. You to understand, right? Hope you're following me.
Yes, sir. Yes, sir.
Whereas if you see the currency option contract, because in currency derivatives only we have these two main options, currency future and currency options. So when I say the example of currency option contract, that gives the right but not an obligation to buy or sell a currency at a specified rate on an agreed upon future date. So the buyer of the option contract is referred to as the holder of the contract, whereas the seller is the writer of the contract. So a contract with option to buy a predetermined quantity of currency at a specified rate, we called it as a call option contract. Whereas on the other hand, a contract with option to sell a predetermined quantity of a currency at a specified rate, we call it as a put option contract. So the price at which the call or put option contract is to be executed, we call it as a strike or the exercised price. We call that as exercised price. So the buyer has the rights to exercise the option before the expiry. So there will be a seller has the obligations to fulfill all these concepts. So the contract, if the buyer exercises rights, the buyer pays the seller at a premium in exchange. So the buyer can decide whether they exercise his option or not by comparing the spot or the strike prices. If the strike price of a call option is greater than the spot price, the option is said to be in the money. On the other hand, if the strike price is lesser than the spot price of a call option, then the option is called out of the money. Furthermore, if the strike price is the same as the spot price, the option is at the money. So these are all the things we have to understand. So an option contract may be over the counter or exchange traded, or that can be customized to the specifications of buyer and sellers. So if I say the final word, the essence of hedging and trading in currency derivatives, these all lies in the use of the combination of
Bala
derivative
sir,
products. Yes, ma'am.
sir, sorry to interrupt. Screen share ചെയ്യുന്നുണ്ടോ?
Illa,
We
madam,
are
illa,
not
illa.
able. ഇല്ല
No,
അല്ലേ?
no,
Okay.
I'm not sharing the screen.
Okay, okay, sir.
So remaining just for your understanding I had given. I hope
Okay, sir.
probably you will be sharing the PPT to everyone, right?
Yes, sir. We will
Okay.
share it.
Okay. So the participants in the Forex market, they formulate various strategies to minimize the profit earned and minimize the risk involved. So when I say that the currency derivative strategy, we say the sky is the limit. So it has the highest advantage of trading currency futures and options. Now we have to understand the indicative of the margin requirement of Nifty is 18% to 20%. For gold, if you see 8% to 10%. US Indian dollar combination, if you see 2.50% to 3%. So these are the very good margin requirement. So we have a exchange traded currency future and options has not only opened a new asset class to the individual, but also it gives opportunity to express their price view on US dollar, Indian rupee and other currency pairs. So this will give you the lower transaction cost. Second, smaller contract size. All contracts are of value less than 1 lakh. So easier to take price viewer. Lower volatility compared to the other product. If you see the Nifty, gold, etc., the US dollar, Indian rupee has a lower volatility and hence easier to manage the positions. These are a good advantage. Fourth, if you see the longer trading hours, as a currency market, it trades from morning 9 a.m. to 5 p.m. So one get additional 1.5 to trade in currencies and more time to react. Whereas if you see the higher leverage, because of the low margin, the leverage can go as high as it's high. So these are the highest advantage because you are getting the low margin, the required usually in the range of 2.5% to 5% depending upon the currency pair, irrespective whether it is US dollar or Indian rupee or pound sterling or Indian rupee or euro dollar, euro currency with Indian rupee or Japanese yen with Indian rupee, right? So the currency swap contract talk about the involves in the exchange of the principal and the interest in one currencies against the principal and interest in another currency. So in the beginning of the contract itself, you have to make an equivalent principal amount is exchanged at the spot rate between the contracting parties. So during the tenure of the contract, the contracting parties pay interest on the swapped principal amount, so that at the end of the contract, the principal amount is swapped back either at the spot rate or a predetermined exchange rate. So this rate may also be the original rate for the principal exchange. So in such a case, the transaction risk on the swap is eliminated. So it's a good option. The currency swap, we call it is a very good a contractual agreement between two parties where the frequency for payment, interest rate, exchange rate, etc. are mutually agreed upon the both parties. So thus currency swap contract are over the counter contracts and are completely tailored to the needs of the contracting parties. So if you see that a middleman facilitates the fixing of the terms between the counterparties, such as if you take the broker is referred to as the swap bank or the swap facilitator. Often if I say the swap facilitator is the counterparty to the swap contract. So you have to mention the date of execution of the swap contract in the trade date. So the date on which the acquired interest or accrued on the principal is exchanged or referred to as trade or the value dates. Are you following me? Any doubt?
Yes, sir. I hope we have no doubts yet.
Okay, okay. So last thing, if I want to connote is, which one is more affordable for us? If I say whether we can able to make money, absolutely we can make more money. Because unlike if you see the forward contract and the financial futures options, that gives the buyer opportunity, but not the obligations to buy or sell a financial instrument at pre-agreed price in the future. So that's how this currencies has made. But whereas if you see the foreign currencies in a concept of an option or in future, buyers of foreign currency options commonly use foreign currencies options. That is to protect their foreign currency exposures against the adverse currency movement, so that you can set a known worst case exchange rate that may reduce usage of credit facility. So apart from their foreign exchange rate risk management, it gives a good exposure for the tool strategies. These are all for the buyer perspective I'm telling. If you see for the seller perspective, this will speculate on future currency movement that may generate cash flow through the premiums. It may offset existing foreign currency options, etc. So this is how the currency options are being traded. But commonly, if you see the hedging strategy of using the currency transactions, this involves taking an opposite position in the future market to offset any potential price risk in each segment, in cash segment. So this objective behind the hedging strategy, the mechanism is to offset loss in one market with gain in the another. For example, I'll tell you, if an exporter is likely to receive US dollar after 3 months, so there is a risk of US dollar depreciation. So to offset this risk, the exporter can hedge the US dollar receivables by selling US dollar in the forward or future market. Same alternatively, an importer who has risk of US dollar appreciation can take a long US dollar position in the forward or future markets. I'll give a live example how this risk mitigation by an importer. So this is how the currency derivatives and risk management talk about. If you take any edible oil, refiners want to import soya bean worth of US dollar, that is 1 lakh. So the importer is exposed to risk of Indian rupee depreciation against US dollar. So this could potentially increase his import bill. So the importer places an order on July 15th in 2000, for example, with the delivery and payment date being 3 months ahead, for example in October 2000 or etc. or 2001 etc. So the spot rate at the time of booking the import is July, that is US Indian dollar 43.50. So if Indian rupee depreciate by October, this can result in the loss for the importer. Whereas on the other hand, if the Indian rupee appreciate, this is favorable for the importer. So now you can see the uncertainty of the movement of US dollar Indian rupee in the extent of risk for the importer. So the importer decide to hedge against US dollar Indian rupee volatility using the exchange traded currency futures. So that you need what are all the item? You need spot rate of US dollar Indian rupees 43.50. You will be trading in multi-commodity stock exchange with US dollar Indian rupee futures. Right. You need hedging strategy. So buy 100 lots of multi-commodity stock exchange of October US dollar Indian rupee future contract. That's on July 15th, 2000. So this is how you can able to mitigate. Same thing if you see in terms of the exporter, any of the good example of a diamond jewelers exporter, they have obtained export order worth of US dollar 2,50,000 on August 20th, 2000. So you will be the deliver of jewelers against the payment in December 2001. So the exporter is exposed to risk of Indian rupee appreciation against US dollar. So this could again potentially decrease his revenue from export. So that the spot rate at the time of booking the export in August is US dollar Indian rupees 45 rupees 50 paise. So if Indian rupee appreciate by December, this can result in loss for the exporter. Whereas on the other hand, if Indian rupee depreciate, this is favorable for the exporter. So this uncertainty of the movement of US dollar Indian rupee is extent of risk for the exporters. So that is how the exporter decided to hedge against US dollar Indian rupee volatility using the exchange traded currency futures. Clear? So here you have the role of investment strategies. So the speculators play here a vital role in the future markets. So speculation is also not similar to the manipulation. So a manipulator tries to push prices in the reverse directions of the market equilibriums, while the speculator forecasts the movement in price and the effect eventually being the price brings the price closer to the market equilibrium. Right. So with this I will stop because I should not bore you also. So this is how I'm giving the general outline about the currency derivative. So as far as the investment strategy is concerned, it is a very good option for the investor to think about invest in currency derivative rather than depositing in banks or in other field. Right. So thank you very much for giving me this wonderful opportunity. I hope I have not took much time also. I have restricted my talk to the limited duration.
Thank you, sir.
Thank you.
Mini ma'am. Do we have any questions from the participants side? You may also use the chat box to post your questions.
Sir,
Sir, Bala sir, you're muted.
Yes, ma'am.
sir, I have one doubt, sir. During the session, you have told only 1% of the contracts leads to physical delivery. Only one. Am I audible, sir?
Yes, ma'am. You're audible.
Yes, yes. What is the reason for that? Other 99% of contracts, I think it is converging. What is the reason for that?
Basically depends on the product, and the second thing based on the geopolitical affairs. Third
Yes.
thing based on the traders.
Okay, sir. This is only applicable to currency derivatives, or it can be applied to credit and equity, then commodity.
Currency derivatives, ma'am.
Okay, sir. Okay, sir. Okay, thank you,
More
sir.
or less similar only, but still there are some differences also. Here I have focused only on the currencies. I am not ready to have the similarity of comparison with equities or other domain. I have not taken also.
Okay, thank you,
If you
sir.
give me another opportunity, I will connote how this equity markets that may compare with your currency derivative. Like that we can give a good comparisons also.
Okay, sir. Okay, thank you,
That
sir.
field is more required. Thank you, ma'am.
Sir, we don't have any queries from the participant side. Shall we wind up the session, sir?
Yes, ma'am. Thank you. Thank you for giving me this wonderful opportunity.
Mini ma'am.
Okay. On behalf of Postgraduate Department of Commerce, Sri Sankara College, Kalady, I take this opportunity to propose vote of thanks to our honorable resource person, Dr. P. Balasubramanian, for the excellent presentation and making this session a very meaningful and interesting. We are really enlightened with your knowledge and presence. Thank you, sir. A special thanks to the organizing committee and faculty members for your support and coordination. Our heartfelt thanks to the participants for your active participation. Once again, thanks to one and all. Thank you.
Thank you, madam. And thank all the participants and the organizers. Thank you. Thank you very much. Thank you. Shall I leave, ma'am? Okay.